Enthusiastically welcome the listener to a new episode on the Gap Advisors and Ask Clinic podcast.
Thanks for having me. I'm really excited to get into this one.
Yeah, me too, because, there is this concept in the business world, and frankly, even in everyday life, that sounds so inherently responsible. You rarely ever question it.
Oh, absolutely.
It's a word that, conjures up images of careful planning, a steady hand on the wheel, protecting what you have.
Yeah.
And that word is prudence.
Right. Prudence. It sounds so safe.
It really does. But what we're going to explore today in this deep dive is how that seemingly innocent, highly respectable word can actually be, weaponized.
Yeah. Weaponized is the perfect way to put it.
We're going to look at how prudence can be deployed as a very clever, very effective mask for fundamental non-compliance in corporate financial reporting.
And, it is one of the most fascinating psychological tricks in the entire financial ecosystem.
How so?
Well, when management uses the word prudence in their disclosures, the immediate reaction of a reader or an investor or even sometimes an auditor is to just lower their guard.
Like, oh, they're being careful, so I don't need to worry.
Exactly. It signals, hey, don't worry, we are being extremely conservative here. But as we're about to uncover today, that conservatism can sometimes be a complete illusion.
An illusion designed to hide something, right?
Yeah, designed to hide a mathematical reality that the company simply does not want to put down on paper.
And we aren't just philosophizing here. For anyone listening, we have a very specific real-world case study.
We do. Real numbers, real stakes.
Right. Our source material for this deep dive is a published set of Ind AS financial statements from an actual listed company. These aren't theoretical numbers.
No, not at all.
These statements were downloaded and reviewed independently on a suo motu basis by Gap Advisors. So we are going to put a microscope over one specific disclosure they made regarding the non-recognition of income on credit-impaired loans.
But, before we put that disclosure under the microscope, we need to set the boundaries for our analysis today.
Good idea. Let's lay the ground rules.
So for everyone listening, please remember that in all our discussions, the functional currency and the presentation currency is the Indian rupee, or INR.
Okay, got it. INR.
Right. And any other currency we might mention conceptually is considered a foreign currency.
Makes sense.
Additionally, the reporting period we are referencing strictly runs from April 1st to March 31st.
Perfect. And I also need to state clearly right at the top that the views expressed in this deep dive are the personal views of the author of our source material, and they are not binding on you, the audience.
Very important point to make.
Yeah, we strongly advise you to seek the help of a qualified expert before taking or refraining from any action based on the highly technical matters we're discussing today.
And for those who want to read the primary source material for themselves, the observation we are dissecting today is featured in the 23rd edition of the Gap Advisors Task Weekly newsletter.
Oh yeah, the Task newsletter is great.
It really is. This is authored by C.A. Manish C. Iyer, the director of Gap Advisors, and it is published directly on LinkedIn.
And there are a lot of editions, right?
Yeah, over 230 editions have been published to date. It is just an incredible archive of technical knowledge. So if you are on LinkedIn, I highly recommend you subscribe to that newsletter for free.
Definitely. Okay, so let's get into the actual disclosure.
Let's do it.
When I first read the sentence this listed company put into their financials, my initial reaction was, oh yeah, that makes total sense.
It sounds completely logical on the surface.
It does. It sounds entirely reasonable to a layperson. I'm going to read you the exact quote from their significant management judgments section.
Go for it.
Quote, as a matter of prudence, income on credit-impaired loans is recognized as and when received and/or on accrual basis when expected realization is higher than the loan amount outstanding, end quote.
Right. So let's pull that apart, because there is a lot of heavy lifting being done by some very specific phrasing in that one sentence.
It's a dense sentence.
It is. The company is essentially making a declaration to its shareholders. They're saying, look, we have loans on our books that have gone bad. They are credit impaired.
Borrowers are defaulting.
Exactly. The borrowers are defaulting. So because we are exercising such incredible prudence, we have decided we are not going to recognize any interest income on these bad loans unless two highly unlikely things happen.
Which are?
Either the borrower miraculously shows up with physical cash, or we somehow forecast that we are going to recover more money than the total outstanding loan amount.
See, to me, and I suspect to anyone listening who manages their own household budget, that just sounds like common sense.
I know, it's very relatable.
It's like a person driving down the highway. If the engine starts smoking and making a horrible grinding noise, the prudent thing to do is to pull over, turn the car off, and stop assuming you're going to reach your destination on time.
Right.
I mean, why would a company keep recording interest income, counting their chickens before they hatch, when the borrower has clearly stopped paying?
Well, the problem with that logic in the realm of corporate accounting is that it conflates the biological reality of a dying asset with the mathematical requirements of how we measure that death.
The mathematical requirements. Okay.
Let me offer a different analogy. Using prudence to stop recognizing this interest income is not like pulling the car over.
What is it like then?
It is like a driver seeing a massive traffic pile up ahead and deciding that the prudent thing to do is to put on a blindfold.
Putting on a blindfold? Wait, how so?
Because if they put on the blindfold, they don't have to look at the crash. They can pretend the road is clear.
Oh, wow.
Yeah. In financial terms, this company is using the concept of prudence to artificially halt the mechanics of income recognition.
Just to avoid looking at the problem.
Specifically because doing so allows them to avoid looking at the much larger, much more painful reality sitting on their balance sheet.
And that violates the rules, right?
Yes. They are violating the fundamental architecture of how financial instruments must be measured under the current accounting framework.
And the rule book we are talking about here, just to be clear, is Ind AS 109, which governs financial instruments.
Yes. And this is a critical point for any listener, no matter where you are tuning in from.
Because it's not just an Indian standard.
Exactly. While we are operating within the Indian accounting standards framework, Ind AS 109 is entirely convergent with the global standard, IFRS 9.
Oh, really?
Yeah. There is absolutely no difference between Ind AS and IFRS regarding the specific mechanics we're about to discuss.
So this is a global issue.
Absolutely. Therefore, this entire deep dive applies to any entity globally that is following the IFRS framework.
With one exception, right?
Right. The only exception will be when we discuss a specific Reserve Bank of India draft later on. But the core mathematics of a credit-impaired loan, those are universal.
Man, that significantly broadens the scope of this issue. If this listed company is getting it wrong and they are using globally applicable rules, the implications are massive.
They really are.
So, if the blindfold approach of just ignoring the interest is fundamentally a violation, we need to understand what Ind AS 109 actually demands.
Right. We have to look at the actual math.
Yeah, why is the standard forcing a company to calculate interest on a loan that is clearly failing?
To understand that, we have to look at the underlying economic philosophy of the standard, specifically the concept of the time value of money.
Okay, the time value of money.
The framework doesn't view a loan merely as a static pile of cash that might or might not come back. It views a loan as a contractual right to receive cash flows over time.
Over time.
Even if a loan becomes impaired, even if the borrower stops paying, the passage of time continues. And in finance, the passage of time always has a cost, and it always has a mathematical value.
So the standard says you can't just pause time because the borrower is in default?
Precisely. If you expect to recover even a tiny fraction of that loan eventually, say you have collateral you can sell in 3 years, the present value of that future recovery increases as time passes, and you get closer to the recovery date.
Because you're getting closer to actually having the cash.
Yes. That unwinding of the discount as time passes mathematically manifests as interest income. You don't get to just turn the machine off because management feels prudent. You have to follow the formula.
Okay, let's get into the actual machinery of this formula. The source points us directly to paragraph 5.4.1 of Ind AS 109.
Yes, paragraph 5.4.1 is the key here.
This seems to be the epicenter of the rules regarding how interest revenue must be calculated using the effective interest method.
It is.
And it outlines 2 specific scenarios where the normal calculation changes because the asset is impaired. Let's tackle the first one, Scenario A.
Scenario A deals with a very specific class of assets. These are what the standard calls POCI, purchased or originated credit-impaired financial assets.
POCI. Okay, so to translate that, these are loans or bonds that were already in a state of default or heavily distressed the very moment the company acquired them.
Exactly right.
You didn't give out a healthy loan that went bad. You actively went into the bargain bin and bought a deeply troubled asset at a massive discount.
That is exactly what it is. It's the distressed debt market. Now, for these specific POCI assets, paragraph 5.4.1 dictates that the entity must apply what is called a credit-adjusted effective interest rate.
A credit-adjusted rate.
And they must apply this rate to the amortized cost of the financial asset right from the initial recognition.
Meaning, because you knew it was toxic when you bought it, you don't use a normal interest rate. You mathematically bake the expected credit losses into the interest rate itself from day one.
Yes, exactly. The rate itself is modified to reflect the reality that a significant portion of the contractual cash flows will never materialize.
That makes sense.
Like a complex calculation, but it ensures that the income recognized over the life of that distressed asset accurately reflects the deep discount you paid for it.
Right.
However, while POCI is important, it is generally a specialized area. Scenario B is far more common, and it is exactly what we are dealing with regarding our listed company's disclosure.
Okay, let's break down scenario B then. This is for assets that were perfectly healthy when they originated, but have subsequently become credit impaired.
The classic good loan gone bad.
Right. A standard corporate loan, a retail mortgage, a vehicle loan starts off fine. The company applies the normal effective interest rate to the gross carrying amount. Everyone is happy.
Yep, smooth sailing.
But then the borrower faces financial ruin. The loan transitions through the stages of impairment and finally hits stage 3. It is now classified as a credit-impaired financial asset.
And what does paragraph 5.4.1 tell the company to do at that exact moment?
Yeah, what's the rule?
It dictates a fundamental shift in the math. The standard states that for the subsequently impaired assets, the entity must apply the original effective interest rate to the amortized cost of the financial asset in all subsequent reporting periods.
I need to pause you right there because this term, amortized cost, is the absolute hinge on which this entire deep dive turns.
It really is the core of it all.
We hear it all the time in finance. But when a loan is actively failing, what does it actually mean?
I want to ground this in a tangible example so you, the listener, can really see the mechanics. Let's invent a scenario.
I think an example is the only way to truly illuminate this.
Okay, let's do it.
Let's imagine a listed non-banking financial company, an NBFC. We'll call them Alpha Finance.
Alpha Finance, okay.
Alpha Finance issues a substantial corporate loan of, say, 100 crores to a logistics company. And the interest rate, the effective interest rate, is 10% per annum.
Okay, simple enough. 100 crores out the door, 10% interest.
In year 1, the logistics company is doing great. They make their payments. At the end of year 1, Alpha Finance calculates the interest income on the gross carrying amount.
Which is the 100 crores.
Right. So 10% of 100 crores is 10 crores of interest income. This goes straight to their profit and loss statement, making the shareholders happy. And the gross carrying amount remains 100 crores. Textbook accounting. But then year 2 happens. The logistics industry takes a massive hit. Fuel prices skyrocket, contracts are canceled.
Disaster strikes.
Yeah. The logistics company completely stops making payments to Alpha Finance. They are in default.
Now we have a credit-impaired financial asset. Loan has hit stage 3.
Okay, stage 3.
Alpha Finance Management looks at this situation. Under their prudent policy that we read earlier, they would say, well, the borrower isn't paying. We don't expect to receive any cash anytime soon.
So they just turn off the tap.
Exactly. They say, so, out of prudence, we will simply stop recognizing that 10% interest income. We will record 0 interest for year 2.
Which brings us back to Ind AS 109, paragraph 5.4.1, scenario B. The standard says you cannot just declare the interest as 0.
Right, you can't just make it up.
You must apply the 10% rate to the amortized cost.
Yeah.
So walk us through the actual definition of amortized cost. If we open up the standard, where is it defined?
It is explicitly defined in Appendix A of Ind AS 109, and it is not a concept. It is a rigid mathematical formula.
Okay, give us the formula.
Amortised cost is defined as the amount at which the financial asset is measured at initial recognition,
That's our 100 crores.
minus the principal repayments.
Let's say they paid the interest in year 1, but no principal. So we are still at 100 crores.
Plus or minus the cumulative amortization using the effective interest method of any difference between that initial amount and the maturity amount.
Okay, let's assume there were no upfront fees or premiums just to keep the math clean. So we are still holding at 100 crores.
And then comes the final, absolute, most critical variable in the formula.
The big reveal.
The amortized cost is the resulting figure adjusted for any loss allowance.
Adjusted for any loss allowance.
Yes.
Okay, let's apply that to Alpha Finance. They have a 100 crore loan that is dead in the water. The borrower is bankrupt.
Completely bankrupt.
If Alpha Finance is telling the public via their prudent accounting policy that they expect to realize absolutely 0 interest income because the situation is so dire, what does that imply about the actual principal of the loan?
This is where the trap snaps shut. If management truly, honestly believes the situation is so hopeless that they will not recover any future cash flows, not even enough to cover the unwinding of the discount, then they are legally required under the expected credit loss model to recognize a loss allowance that reflects that grim reality.
So they have to show the damage.
If they expect to recover nothing, the loss allowance must be 100%.
100% loss allowance. So they have to take 100 crore hit to their P&L to create that allowance.
Exactly. Now, let's run that through the Appendix A formula for amortized cost.
Okay, let's do the math.
Initial measurement, 100 crores minus loss allowance, 100 crores. What is the resulting amortized cost?
It's mathematically 0 NIL.
And what does paragraph 5.4.1 tell us to do?
Apply the 10% effective interest rate to the amortized cost.
Right.
10% of 0 is, well, 0.
Precisely. You arrive at zero interest income anyway.
Oh.
But, and this is the crucial distinction, you arrived at it through the mandatory rigorous mathematical mechanics of Ind AS 109. You arrived at it because you properly marked down the asset to its true economic value via the loss allowance.
This is a massive revelation. By using the word prudence to just arbitrarily shut off the income tap on the front end, what the company is actually doing is artificially suppressing the income specifically so they don't have to face the music on the balance sheet side.
Exactly. You nailed it.
If they just say, we aren't recording income out of prudence, they can keep that 100 crore asset sitting on their books looking relatively healthy.
Looking healthy, but it's not.
They avoid taking the 100 crore loss allowance hit to their capital. They're keeping a zombie asset alive and masking its decay.
You've isolated the exact motive. They want the benefit of showing a robust asset base to their investors and regulators without the corresponding mathematical reality of the loss allowance driving the amortized cost down.
It's like cooking the books with semantics.
They are severing the mathematical link between the impairment of the asset and the recognition of income. It is a complete failure to comply with the requirements of Ind AS 109.
But wait, let's look at the flip side. What if the situation isn't 100% hopeless?
Okay.
What if Alpha Finance looks at the logistics company and says, okay, they're in default, but they own a fleet of trucks. We can seize those trucks, sell them in 2 years, and we estimate we will recover 40 crores out of the original 100 crores.
That is a perfect scenario to further prove why the prudence policy is non-compliant.
Okay, let's hear it.
Under Ind AS 109, they run their expected credit loss models. They calculate that the present value of that 40 crore future recovery is, say, 35 crores today.
Right, because of the time value of money.
Exactly. That means they need a loss allowance of 65 crores.
Okay, let's run the formula again. Initial amount, 100 crores, minus loss allowance, 65 crores. The amortized cost is now 35 crores.
Correct.
Okay.
And paragraph 5.4.1 mandates that in the subsequent reporting period, they must apply their 10% original effective interest rate to that 35 crore amortized cost.
So 10% of 35 crores is 3.5 crores. They are legally required to recognize 3.5 crores of interest income on their P&L, even though the borrower is in default and isn't paying a dime in cash.
Exactly. Because that 3.5 crores represents the unwinding of the discount. It represents the time value of money bringing that future truck sale closer to the present day.
Ah, I see.
If the company uses their prudent policy and recognizes zero income because cash wasn't received, they are understating their income by 3.5 crores, and they are failing to accurately reflect the economic reality of the recovery process.
Either way you slice it, whether the loan is 100% dead or only partially dead, the prudent policy of just waiting for cash is completely wrong. It bypasses the entire expected credit loss framework.
It renders the multi-million-dollar ECL models that these financial institutions build completely irrelevant on the income side.
This brings up such a vital question for you, the listener. We have gone deep into the weeds of amortized cost formulas and loss allowances.
We really have.
You might be a retail investor, putting part of your salary into a mutual fund or directly into listed company shares. You might be asking, why should I care about paragraph 5.4.1? I'm not an auditor. Why does understanding this specific accounting standard matter to my money?
It matters because financial statements are the only objective lens through which you as an investor can view the reality of a business.
Right.
They are your window into the engine room. When you invest your hard-earned money, you are making a bet on the future cash flows and the risk profile of that entity.
And if they mess with the numbers?
If a company manipulates accounting standards under the guise of comforting words like prudence, that window gets intentionally fogged up.
It's a distortion of the fundamentals.
It is a massive distortion. Let's look at the impact of this specific trick. By avoiding the proper calculation of amortized cost, the company is artificially inflating their asset base.
Making things look better than they are.
They are telling you they have more valuable loans than they actually do. Simultaneously, they are masking their true credit risk.
Because they aren't taking the loss allowance.
Right. If they recognized the full required loss allowance to drive the interest to zero, you, the investor, would see a massive hit to their profitability. You would see their capital adequacy ratios drop. You would realize the company is in distress.
But because they hide behind prudence, the P&L looks smoother. The balance sheet looks fatter.
Exactly. If you are using that fogged-up window to make decisions on whether to buy a stock, hold a stock, or sell a stock,
Yeah,
you are operating on a mirage.
that's terrifying.
It is. You might think you're investing in a stable financial institution, when in reality, its foundations are propped up by credit-impaired zombie loans that haven't been properly provisioned for.
Wow.
Understanding this specific accounting standard is what gives you the power to wipe the fog off the glass. It separates a passive investor who just reads the glossy management commentary from an empowered investor who can spot a massive red flag buried in the significant accounting policies.
It's the difference between trusting the driver who says the road is clear and realizing the driver is wearing a blindfold.
Well said.
But this leads me to a really confounding realization. If this is such a clear, demonstrable violation of the mathematical mechanics of Ind AS 109, why is it happening out in the open?
Yeah, you'd think they would hide it better.
Right. This listed company didn't hide this in a secret internal email. They published it. They printed it in their annual report for the regulators, the auditors, and the entire world to see. Why would a CFO knowingly publish a non-compliant policy?
To understand how this happens, we have to step away from the math for a moment and look at the sociology of corporate reporting.
The sociology of it. Okay.
We have to look at how behavior cascades through an industry. And the source material highlights a truly stunning catalyst for this specific error. It involves what we can call the award-winning error.
Oh man, this part of the newsletter absolutely blew my mind. The source points out that a public sector NBFC, a government-backed non-banking financial company, disclosed this exact same flawed, prudent policy regarding their credit-impaired loans.
Yep.
And rather than being reprimanded, they were actually awarded a Financial Reporting Excellence Award by the Institute of Chartered Accountants of India, the ICAI.
It is an incredible paradox. The supreme accounting body in the country granted an excellence award to a set of financial statements that contained a fundamental misapplication of a core standard.
It's crazy.
And the ripple effects of that single award are monumental. It perfectly illustrates the psychological phenomenon of herd mentality in corporate finance.
Break down how that herd mentality actually plays out in the real world. Let's say I'm the CFO of a mid-sized private NBFC. I'm sitting in my office, drafting my disclosures for the year. I have these bad loans, and I'm terrified of taking the massive loss allowance hit.
So you look around for precedent, you look at your peers, you pull up the annual report of this massive public sector NBFC.
Because they're the big players.
Right. You see that they have bypassed the amortized cost math. They simply stated, as a matter of prudence, we aren't recognizing income. And then, crucially, you see the photograph of their executives standing on a stage, accepting a heavy trophy for financial reporting excellence from the ICAI.
What conclusion am I going to draw? I'm going to assume this is the gold standard. If the ICAI gave them an award, this policy must be bulletproof.
Exactly.
You think it's safe? It must represent the highest echelon of regulatory compliance. I'm going to copy and paste that exact paragraph directly into my own financials.
That is exactly what happens. The award creates a halo effect. It blinds the rest of the industry to the actual text of the standard.
They don't even bother reading it.
And suddenly, dozens of other NBFCs, both in the public and private sectors, are blindly copying this flawed disclosure. They enter an echo chamber of bad policy. Nobody goes back to read paragraph 5.4.1 because they assume the award committee already did the heavy lifting.
But surely, as a private CFO, I might rationalize this. I might look at that public sector entity and think, well, they're backed by the government. Maybe there is a special carve-out for them.
A lot of people think that.
Maybe the rules apply differently to public sector NBFCs, and I'm just borrowing their strategy. Is there any validity to that? Are there unwritten rules or exemptions for these public entities?
I want to be incredibly clear on this point to dispel any myths. There is absolutely no exemption from the application of paragraph 5.4.1 of Ind AS 109 for public sector entities. None.
So they have to follow the exact same rules.
The requirements of the Indian accounting standards apply with equal force to both public sector entities and private sector entities that prepare their financial statements under the Companies Act, 2013. The math does not care who your major shareholder is. The standard is the standard.
So the award didn't validate the math. The math was always wrong. The award just accidentally franchised the error across the entire sector.
Precisely. And this systemic, industry-wide failure highlights something absolutely critical for anyone operating in this space. The immense, indispensable value of independent, rigorous review.
You can't just follow the herd.
You cannot rely on herd mentality.
And
You
people
cannot
just-
rely on what won an award last year.
This is exactly why the Suwamoto reviews conducted by Gap advisors are so vital. When the entire industry is running in the wrong direction, blinded by a halo effect, you need an independent, objective voice that strips away the noise and looks exclusively at the raw text of the rulebook.
Getting financial statements reviewed for Ind AS compliance by deep technical experts before signing them is a crucial safeguard. It protects the CFO, it protects the audit committee, and ultimately it protects the investor.
It's just smart practice.
You do not want to fall into the trap of copying flawed, award-winning disclosures that leave your company non-compliant and vulnerable to future regulatory action.
And for any professionals listening, whether you are drafting the financials or auditing them, you don't have to navigate this echo chamber alone.
No, you definitely don't.
You can actually submit your financial statements in a near-to-publishing PDF format directly by email to info@gasadvisors.com for a comprehensive review. Again, that is info@gasadvisors.com. Having that expert set of eyes can prevent a catastrophic public error.
It is about breaking the cycle of unquestioned precedent.
So we have an entire sector of NBFCs currently stuck in this echo chamber, leaning heavily on the word prudence to avoid the brutal math of amortized cost.
Yep, they feel safe in numbers.
They feel perfectly safe because everyone around them is doing the exact same thing. But as we read further into the source material, it becomes clear that this illusion of safety has an expiration date.
The clock is ticking.
There is a massive regulatory earthquake building offshore, and it is going to hit the mainland very soon.
Yes. The era of hiding behind prudence is coming to an end, and the catalyst is coming from the highest regulatory authority in the financial sector, the Reserve Bank of India.
Let's dive into this because this is where the future of the industry is being written. The RBI has issued a draft document for public comments.
A very important draft.
It is titled The Asset Classification, Provisioning, and Income Recognition Directions 2025. And while 2025 is in the title, these directions, once finalized, are slated to come into effect from April 1st, 2027.
That timeline is critical. It gives the industry a window to prepare, but the destination is already locked in.
So what's changing?
When you analyze the text of this draft, particularly paragraph 83, you see a masterpiece of regulatory convergence. For years, there has been a tension between the RBI's prudential banking norms and the pure accounting standards of Ind AS. This draft is the RBI explicitly bridging that gap.
How so? What does paragraph 83 actually say?
When you read paragraph 83 of the draft, it is astonishingly similar, almost identical in intent, to the requirements of paragraph 5.4.1 of Ind AS 109 that we just spent so much time dissecting.
Really? They're copying the accounting standard.
It mandates the exact same mathematical reality for the banking sector.
So they're finally forcing the banks to do the math.
Yes. Let's look at the subsections. For Part A, dealing with POCI assets, those purchased or originated credit-impaired assets, the RBI draft states that a bank shall apply the credit-adjusted effective interest rate to the amortized cost of the financial asset since initial recognition.
That is a direct mirror of the Ind AS 109 scenario A.
Exactly. And for Part B, covering financial assets that are not POCI but subsequently have become credit impaired, which the RBI traditionally categorizes as being under default, or Stage 3, the draft is equally explicit.
And what's it say?
It says banks shall apply the original effective interest rate to the amortized cost of the financial asset in subsequent reporting periods from the date of the asset becoming credit impaired.
Wow. The central bank is literally writing the Ind AS 109 amortized cost formula directly into the mandatory banking regulations. There is no more wiggle room, no more prudence exceptions.
The RBI is definitively stating that true prudence means recognizing the economic reality of the asset, time value of money included.
That's a huge shift.
But here is the crucial regulatory nuance we must clarify. The scope of these specific 2025 directions, when they become effective in 2027, applies strictly to commercial banks.
Just the banks.
They do not legally directly apply to the NBFCs, the non-banking financial companies that we've been focusing on.
Wait, so the NBFCs are off the hook. They can just keep using their flawed prudence policy while the major banks are forced to change.
Not at all. And this is where market dynamics will ruthlessly override any perceived regulatory gap.
How so?
Consider the ripple effect. The commercial banks are the titans of the financial system. Once they are legally forced by the RBI to recognize interest on credit-impaired loans based strictly on amortized cost, the entire reporting baseline of the country shifts overnight.
I see the dynamic you're pointing to. It's like the biggest, heaviest freighter in a crowded harbor suddenly deciding to dramatically change its course.
Yes, great analogy.
The banks are those massive freighters. When they turn the wheel in 2027 to comply with the RBI, they are going to displace an enormous amount of water. They are going to create a massive wake. All the smaller boats in the harbor, the private and public NBFCs, are going to be violently rocked by that wake.
That is a perfect visualization. The financial markets run on comparability. Analysts, institutional investors, and rating agencies demand to be able to compare apples to apples.
Right. If they can't compare, they get nervous.
Exactly. If the massive commercial banks are universally reporting their interest income on impaired loans using the precise amortized cost method, those same analysts are going to turn their gaze to the NBFCs.
And they're going to start asking questions.
They are going to ask, why are your numbers calculated completely differently? Why are you still hiding behind this subjective prudence excuse when the banks have modernized?
The market pressure will be unbearable.
It will be. The NBFCs will realize they are totally out of sync with the accepted industry standard. They will look like outliers. And in finance, looking like an outlier often translates to a higher cost of capital.
Because risk goes up.
Exactly. They will be forced, by sheer market gravity, to abandon their flawed policy and align their math with the banks.
But this creates a massive logistical nightmare for these NBFCs. You can't just change the foundational math on millions or billions of rupees of bad loans without it causing a massive disruption in the financial statement.
No, it's going to be incredibly messy.
When 2027 rolls around and these NBFCs inevitably pivot to match the banks, how are they possibly going to explain this sudden massive shift in their income and loss allowances to their shareholders?
And that question brings us to the absolute climax of this deep dive, because how they choose to explain it will likely set a trap for the unwary investor.
Okay, let's unpack this future trap, because we need to talk about the mechanisms companies use to explain when their numbers drastically change. To understand the trap, we have to introduce one more piece of the regulatory puzzle, and that is Ind AS 8.
Ind AS 8 is the overarching standard that governs accounting policies, changes in accounting estimates, and errors.
So it's the rulebook for fixing things.
It acts as the ultimate referee when a company wants to alter how it presents its reality.
Our source material quotes a very specific, very vital line from paragraph 7 of Ind AS 8. It reads, quote, "When an Ind AS specifically applies to a transaction, other event, or condition, the accounting policy or policies applied to that item shall be determined by applying the Ind AS." End quote.
It is a dry sentence, but its implications are absolute. Let's connect that mandate back to the core argument we've been tearing down today.
The prudence defense.
Exactly. The listed company claimed that as a matter of prudence, they established an accounting policy to ignore the income. Ind AS 8, paragraph 7, completely invalidates that defense.
Because Ind AS 109 already covers it.
Because Ind AS 109 specifically applies to credit-impaired loans and specifically mandates the amortized cost formula, that is the only accounting policy you are legally permitted to apply.
It removes all the subjectivity. You don't get to look at the menu of accounting concepts, see prudence, and decide to order that instead of the mandatory standard.
Exactly. Income recognition cannot simply be postponed, ignored, or muted just because management feels anxious about their bad loans and thinks it's prudent to hide them.
The rule is the rules.
Provided the recognition criteria under the standard are met, the standard overrides the subjective feeling of the CFO.
So the foundation is set. We know the NBFCs are currently wrong under Ind AS 109. We know Ind AS 8 says they never had the right to choose this wrong policy.
Right.
And we know market pressure will force them to change in 2027 when the RBI rules for banks take effect. I want you to look into your crystal ball.
Okay, I'm looking.
Based on your decades of expertise in observing corporate behavior, what exactly is going to happen in the footnotes of these NBFC's annual reports in 2027? How are they going to spin this capitulation?
I can practically draft the disclosure for you right now because the playbook is so predictable.
Let's hear it.
Come 2027, the NBFCs will quietly capitulate. They will run the new math. They will suddenly start recognizing this interest on their credit-impaired loans based on the proper amortized cost. But, and this is human nature, management will not want to admit they have been publishing mathematically flawed, non-compliant financial statements for the past decade.
No CEO wants to stand up at an AGM and say, we didn't understand the math, sorry.
Exactly. So, in their disclosures, they will employ a brilliant piece of camouflage. They will tell their investors that they have made a proactive change in accounting policy.
Yeah, a proactive change.
They will frame it as a strategic decision to align their reporting with the new, modernized industry norms set by the RBI for the banking sector.
It will sound so positive. Like, dear shareholders, to reflect best practices and align with the newly implemented RBI banking standards, we have elected to voluntarily change our accounting policy regarding interest income. They will paint themselves as progressive.
That is exactly the spin you will see. But we need to make a fundamental, critical distinction here for the listener. A distinction that changes everything about how you view that company.
Which is?
For the commercial banks, reacting to the new 2025 RBI directive and implementing it in 2027 is, in fact, a legitimate, legally mandated change in accounting policy. The regulatory framework governing them has officially evolved.
Right, the rules for the banks actually changed.
But for the NBFCs, the rules never changed. They were always exclusively governed by Ind AS 109.
It never had an exemption.
They never possessed an exemption from the RBI to ignore the standard. They were fully subject to paragraph 5.4.1 this entire time. Therefore, when an NBFC finally fixes this math in 2027, it is legally and factually impossible for it to be a change in accounting policy.
If it's not a policy change, what is it?
Under Ind AS 8, it is the rectification of a prior period error.
A prior period error? That sounds incredibly severe.
It is the difference between night and day in the accounting world. A policy change implies evolution, adaptation, moving forward.
And an error.
A prior period error implies historical failure. It is an admission that you were fundamentally non-compliant with the law in the past. It means your previously published financial statements, the ones investors relied upon to buy your stock, were materially misstated.
And the mechanical consequences of a prior period error are brutal, aren't they? If a company admits an error, they can't just fix it moving forward, they have to go backward.
Precisely. Under Ind AS 8, if you are correcting a material prior period error, you have to retrospectively restate your comparative figures.
Reopening the old books.
You have to open up the prior year's numbers, change the math, and adjust your opening retained earnings. It is a messy, highly visible process that shatters investor confidence.
I can imagine the board meetings.
It opens up immediate, uncomfortable questions from the board about internal controls, the competence of the finance team, and the rigor of the external auditors.
Which is exactly why they are going to fight tooth and nail to camouflage it as a proactive policy change. They want to ride the coattails of the bank's legitimate regulatory shift to quietly sweep their own historical non-compliance under the rug.
They will try to pass off a correction of an error as an evolution of policy.
And that is the trap. If you, as an investor or an analyst, accept that disclosure at face value, you are missing the fact that the company's internal reporting controls have been fundamentally flawed for years.
It's a huge red flag that you'd be ignoring.
So consider this deep dive your early warning radar system. We are giving you the coordinates of the trap years before it is sprung. When you are reading the financial statements of NBFCs around 2027, and you see them claiming a certain change in policy regarding how they calculate interest on their credit-impaired loans, your alarm bells should be ringing.
Ringing loudly.
Know that they are likely trying to pass off a historical mathematical mistake as an upgrade. They are trying to hide the fact that they wore a blindfold for years. Do not let them get away with the spin.
Look past the narrative and look at the math.
What an incredible, revealing journey we have just taken. We started with a single innocent-sounding sentence about prudence hidden in a company's footnotes.
It's amazing how much was packed into that one line.
And by relentlessly pulling that single thread, we've unraveled a mathematical violation of a global standard, we've exposed a herd mentality driven by a misunderstood award, and we've mapped out a massive, sector-wide accounting correction and the deception that will likely accompany it.
It truly highlights how deeply embedded these nuances are and how powerful the standards can be when properly understood and applied.
It really just shows how critical it is to fluently understand the language of business. Thank you so much to you, the listener, for taking this expansive deep dive with us today into the fascinating and, as we've clearly seen, sometimes highly deceptive world of financial reporting.
Yes. Thank you for dedicating your time and your deep attention to this complex topic. We truly believe that understanding these intricate mechanics, looking past the comforting words to see the mathematical realities underneath, is exactly what separates a passive, vulnerable investor from an empowered, intelligent one.
Absolutely.
And as we close out this session, I want to leave you with a final, lingering, somewhat provocative thought to mull over.
Okay, let's hear it.
We have just spent the last hour meticulously proving how major financial institutions are willing to misapply something as fundamental and heavily regulated as interest income, specifically to avoid recognizing the full, painful reality of their loss allowances.
Right.
If corporate management is willing to misuse a seemingly noble word like prudence to mask a problem of that magnitude, well, what other prudent management judgments are currently hiding in plain sight in the footnotes of the companies you invest your money in?
What other blindfolds are being worn? What else is lurking in the fine print? It is a question you have to actively ask yourself every single time you open an annual report.
Always be asking.
To help you answer those questions and stay ahead of the curve, we have a few important requests for you. Please follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, and YouTube, whichever platform you prefer to listen on.
And to ensure you never miss an update, I strongly urge you to follow the Gap Advisors Ind AS Clinic channel on WhatsApp. It is by far the fastest, most reliable way to get instant notifications on all our new videos, podcasts, newsletters, new technical issues we've responded to, and any new accounting standards issued by the regulators.
I also want to draw your attention to an absolutely massive, completely free resource that is available to you right this very second. The issue repository on gapadvisors.com.
It's an incredible resource.
This database currently hosts over 4,500 real-world, highly complex issues and their detailed technical responses on both Ind AS and Indian GAAP.
4,500 highly specific resolved issues. It is an unparalleled technical archive for the industry.
And the best part is, anyone, literally anyone, can register for free, submit their own specific issues regarding Ind AS and Indian GAAP, and get a highly detailed, expert response delivered directly to the inbox of the email you registered with gapadvisors.com.
It's incredibly helpful.
This is an extremely helpful tool, particularly for auditors and finance professionals who need rock-solid, citable documentation on how they addressed complex application issues during their audits.
And if you find yourself needing more personalized, direct guidance, remember that you can always book a one-on-one consultation regarding your specific Ind AS and IFRS issues directly with the author of today's source material, C.A. Manish, C.I.R. You can seamlessly book that consultation right from his page on topmate.io.
My final request to you, if you found value, clarity, and insight in this deep dive today, please share it. Share it among your professional contacts, your colleagues, your audit teams, and your finance department.
Please do.
And crucially, please share it with students who are currently pursuing their CA course. Helping to spread the vital, unvarnished, and accurate knowledge of Indian accounting standards is how we clean up the financial ecosystem for everyone. Thank you so much for listening, and goodbye.